In 1949, a 19-year-old kid from Omaha, Nebraska walked into a library. He wasn't looking for anything specific. He was just a young guy obsessed with numbers and money, flipping through books on investing, trying to figure out how the stock market actually worked. And then he picked up a book written by a man he had never heard of, a professor from Columbia University named Benjamin Graham. That kid sat down and started reading, and by the time he finished, his entire world had changed. He later said, and I quote, "Reading this book was the most important moment in my investing life." That 19-year-old kid was Warren Buffett, the same Warren Buffett who went on to become the greatest investor in history, the man worth over $100 billion, the man who has beaten the stock market for more than 6 decades straight. And it all started with this one book, The Intelligent Investor. Now, here is what most people get wrong. They think this book is about picking the right stocks. They think it is about charts and numbers and complicated Wall Street strategies. It is not. This book is about something far more powerful. It is about how to think about money, how to protect yourself from your own emotions, and how to build wealth slowly, safely, and intelligently while everyone else is panicking and gambling. This is the book that created value investing. This is the book that shaped Warren Buffett. And today, I am going to break down every major lesson inside it so you do not have to read all 500 pages yourself. Let's get into it. Before we dive in, if you are someone who wants to get smarter with your money, build real wealth, and learn from the greatest financial minds in history, hit that subscribe button right now. We break down the best finance and self-help books so you don't have to spend weeks reading them. Also, smash that like button because it helps this video reach more people who need to hear this. And if you want to grab your own copy of The Intelligent Investor, I have put the Amazon link right in the description below. Trust me, this is one of those books that should be on every investor's shelf. Now let's get into who Benjamin Graham actually was and why his ideas changed the world of investing forever. Who was Benjamin Graham? Benjamin Graham was born in London in 1894, but his family moved to New York when he was just 1 year old. And from the very beginning, life was not easy for him. When Benjamin was 9, his father passed away. The family went from being comfortable to being completely broke almost overnight. His mother tried to make money in the stock market, but she lost nearly everything in the crash of 1907. Young Benjamin watched his family go from having a decent life to struggling to put food on the table. And that experience shaped everything. That pain of watching money disappear because of emotional decisions and reckless speculation became the foundation of his entire philosophy. But Benjamin was brilliant. He graduated from Columbia University at the top of his class. He was offered teaching positions in 3 different departments: English, mathematics, and philosophy. But instead, he chose Wall Street. By his mid-20s, he was already making over $500,000 a year on Wall Street. And that was in the 1920s. Adjusted for today, that is millions. But then the Great Depression hit in 1929, and Graham lost almost everything, nearly went bankrupt. Most people would have walked away from investing forever after that. But not Graham. Instead of quitting, he studied his mistakes. He analyzed what went wrong. And from that failure, he built a system, a set of principles designed to protect investors from the exact mistakes he had made. He went on to teach at Columbia University for nearly 3 decades. One of his students was a young man named Warren Buffett, who later called Graham the second most influential person in his life after his own father. Benjamin Graham did not just write a book. He invented an entire way of thinking about money. And that is what we are going to learn today. Investment versus speculation. The very first thing Benjamin Graham does in this book is draw a clear line in the sand, a line that most people today still do not understand. And that line is the difference between investing and speculating. Now, most people think they are the same thing. They think buying a stock is investing, but Graham says no. Buying a stock can be investing or it can be gambling. It all depends on how you do it. Here is how Graham defines it. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything that does not meet these requirements is speculation. Let me break that down. First, thorough analysis. That means you actually studied the company. You looked at the numbers, you understand what the business does, how it makes money, and whether it is financially healthy. You did not just buy it because your friend told you to, or because you saw it trending on social media. Second, safety of principal. That means your number one goal is to not lose money. Not to double your money overnight, not to hit some massive jackpot, but to protect what you already have. Third, an adequate return. Not an insane return, not 1,000% in a week, just a reasonable, steady, honest return over time. If your approach checks all three of those boxes, you are investing. If it does not, you are speculating. And Graham says there is nothing wrong with speculating as long as you know that is what you are doing. The danger comes when people speculate but believe they are investing. Think about it like this. Imagine two people walk into a casino. One of them knows he is gambling. He sets a limit, plays for fun, and walks out when his budget is done. The other one genuinely believes he has a system to beat the house. He keeps doubling down, convinced he is making smart decisions. Who do you think loses more money? That second guy is what Graham calls the speculator, who thinks he is an investor, and Wall Street is full of them. People chasing hot tips, jumping on trends, buying stocks they do not understand because the price went up last week. Graham wrote this in 1949, and it is even more true today. With trading apps on your phone, social media hype, and overnight millionaire stories everywhere, the line between investing and speculating has never been more blurred. And Graham's message is simple. If you want to build real wealth, stop gambling and start investing. Do your homework. Protect your money first, and be patient. That one distinction alone can save you from losing thousands of dollars. And it is only chapter 1, the investor and inflation. Now, most people think the biggest threat to their money is a stock market crash. They picture some dramatic moment where the market drops 50% overnight and everyone panics. And sure, that is scary. But Graham says there is a much quieter and much more dangerous enemy that destroys wealth every single day without anyone even noticing. That enemy is inflation. Here is how inflation works in simple terms. Let's say you have $100,000 sitting in your bank account right now. Feels safe, right? It is just sitting there, not going anywhere, not losing value. Except it is. Every single year, inflation silently eats away at the purchasing power of your money. If inflation is running at 3% a year, which is pretty normal, then in 10 years that $100,000 will only buy you what $74,000 can buy today. In 20 years, it is worth barely $55,000 in today's money. You did not spend a dime. You did not lose it in some bad investment. It just slowly melted away while you thought it was safe. That is what Graham wants you to understand. Doing nothing with your money is not the safe choice. It is actually one of the most dangerous choices you can make. Now here is where it gets interesting. Graham says a lot of people think they can beat inflation by putting all their money in stocks. And while stocks have historically beaten inflation over the long run, Graham warns that it is not that simple. Stocks go through terrible periods too. There have been stretches of 10, 15, even 20 years where the stock market went absolutely nowhere. So what does Graham recommend? He says the intelligent investor should always hold a mix of stocks and bonds. Never go all in on one or the other. When stocks seem overpriced and risky, you increase your bond allocation. When stocks seem cheap and the market is in panic mode, you shift more towards stocks. Graham's general rule is simple. Never have less than 25% of your money in stocks and never have less than 25% in bonds. The rest you adjust based on market conditions. This is not about getting rich fast. This is about making sure inflation does not quietly rob you while you think your money is safe. It is about building a portfolio that grows steadily and survives every kind of market. Most people either ignore inflation completely or panic about it and make dumb decisions. Graham says the intelligent investor does neither. You acknowledge inflation as a real threat, you build a balanced portfolio to fight it, and you stay disciplined no matter what the market is doing. Because the biggest risk to your wealth is not a crash. It is standing still while everything around you gets more expensive. Portfolio policy for the defensive investor. Now, Graham divides all investors into two types, and this is one of the most important ideas in the entire book. He says you are either a defensive investor or an enterprising investor. And which one you are changes everything about how you should handle your money. Let's start with the defensive investor. And before you think defensive sounds weak or boring, Graham actually says most people should be this type, including some very wealthy and successful people. The defensive investor is someone who wants two things: safety and freedom from hassle. They do not want to spend hours every week analyzing stocks. They do not want to stress about the market every day. They want to put their money somewhere smart, let it grow, and get on with their life. Graham says there is absolutely nothing wrong with this. In fact, he says the defensive investor who follows a disciplined plan will almost always outperform the average person who is constantly trading and chasing hot stocks. So what should the defensive investor actually do? Graham lays out very clear rules. First, diversify. Own between 10 and 30 different stocks. Never put all your eggs in one basket. No matter how much you love a company, never let one stock become your entire portfolio. Second, stick to large, established, financially sound companies. These are companies that have been around for decades. Companies with long track records of paying dividends. Companies with strong balance sheets and consistent earnings. Graham says you should avoid small, unproven companies entirely if you are a defensive investor. Third, make sure every company you own has a long history of paying dividends. Graham specifically says at least 20 years of uninterrupted dividend payments. That sounds extreme, but his logic is simple. A company that has paid dividends for 20 straight years has proven it can survive recessions, market crashes, and tough times. That track record is your safety net. Fourth, do not overpay. Graham says even a great company is a bad investment if you pay too much for it. He suggests setting a limit on the price you are willing to pay relative to the company's earnings. His guideline is to never pay more than 25 times the average earnings of the last 7 years, or 20 times the earnings of the last 12 months. Now here is the beauty of this strategy. It is boring, it is not exciting. Nobody is going to make a movie about a guy who bought 30 blue-chip dividend stocks and held them for 20 years. But that boring strategy has beaten the majority of professional fund managers over time. Graham says the defensive investor's biggest advantage is not skill. It is discipline. While everyone else is panicking and selling at the bottom or getting greedy and buying at the top, the defensive investor just stays the course, keeps buying quality, keeps holding, keeps collecting dividends. And over time, that boring discipline creates extraordinary wealth. Graham puts it perfectly. The investor's chief problem, and even his worst enemy, is likely to be himself. The defensive strategy is designed to protect you from yourself, from your own fear, your own greed, and your own impatience. If you can follow these simple rules and resist the urge to do something clever, you are already ahead of 90% of investors out there. Portfolio policy for the enterprising investor. Now, if the defensive investor is the person who wants safety and simplicity, the enterprising investor is the one who is willing to put in the work, the one who wants to go beyond average returns and is ready to dedicate serious time and effort to do it. But here is where Graham surprises most people. He does not start by telling the enterprising investor what to do. He starts by telling them what not to do. Graham calls this the negative approach, and it is brilliant. He says before you even think about finding great investments, you first need to learn what to avoid. Because in investing, not losing money is more important than making money. So what should the enterprising investor avoid? First, high-yield bonds that look too good to be true. If someone is offering you an unusually high interest rate, there is a reason. It usually means the risk of default is extremely high. Graham says chasing high yields is one of the fastest ways to lose your principal. Second, avoid new stock offerings. When a company goes public for the first time, there is usually a massive amount of hype around it. Everyone wants to get in early. Everyone thinks they are going to buy the next Apple or Amazon at the ground floor. But Graham says the vast majority of IPOs are sold to the public at inflated prices. The insiders and investment banks take most of the profit. By the time you get in, the easy money is already gone. Third, avoid companies that are growing fast but have no real earnings to back it up. Graham was writing this decades before the dot-com bubble, but he basically predicted it. Companies with amazing stories but no actual profits are dangerous. Growth without profitability is just a beautiful promise with no foundation. Now, once you know what to avoid, Graham lays out the positive approach, what the enterprising investor should actually look for. He says you should hunt for bargains, stocks that are selling for significantly less than what the company is actually worth. These are companies the market has ignored, forgotten, or unfairly punished. Maybe the company had one bad quarter and the stock dropped 40% even though the underlying business is still solid. That is where the enterprising investor steps in. Graham also says to look at companies going through temporary problems, not permanent decline, temporary problems. A great company hit by a short-term setback will often see its stock price crushed by fearful investors. But if the business fundamentals are still strong, that is an opportunity. The key word here is temporary. Graham is very clear about this. You are not looking for broken companies, you are looking for good companies at broken prices. Now here is the catch. This takes real work. You have to read financial statements. You have to understand balance sheets. You have to analyze earnings and debt and asset values. You have to think independently while everyone else is either panicking or celebrating. Graham says most people are not willing to do this, and that is fine. That is why the defensive strategy exists. But if you are willing to put in the hours, the enterprising approach can deliver significantly better returns. However, Graham gives one final warning. Being an enterprising investor is not about being more aggressive or taking more risk. It is about doing more research. The enterprising investor does not take bigger gambles, they do bigger homework, and that homework is what gives them the edge. If you are not willing to do the work, stay defensive. There is no shame in it. But if you are willing to roll up your sleeves and truly study the businesses you invest in, the rewards can be life-changing. The Investor and Market Fluctuations. Chapter 8 is the most famous chapter in this entire book. This is the chapter Warren Buffett has talked about more than any other. This is where Graham introduces his legendary parable of Mr. Market. And once you understand this concept, you will never look at the stock market the same way again. Graham asks you to imagine something. Imagine you own a small business, a solid, profitable business that makes good money year after year. Now imagine you have a business partner named Mr. Market. Every single day, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his share, and every single day, he quotes you a different price. Some days, Mr. Market is in a fantastic mood. He is optimistic, excited, and convinced the business is going to take over the world. On those days, he offers you a ridiculously high price for your share, way more than it is actually worth. Other days, Mr. Market shows up in a complete panic. He is terrified, depressed, and convinced the business is about to go bankrupt. On those days, he offers to sell you his share for almost nothing, way less than it is actually worth. Now here is the key. Mr. Market does not force you to do anything. He just shows up, quotes a price, and waits. If you do not like his offer, you can simply ignore him. He will be back tomorrow with a completely different price. He never gets offended. He never goes away. He just keeps showing up. Graham says the stock market works exactly like Mr. Market. Every single day, the market gives you a price for the stocks you own. Sometimes that price is rational. Sometimes it is absurdly high. Sometimes it is ridiculously low. And most people make the catastrophic mistake of letting Mr. Market tell them what their stocks are worth. When Mr. Market is excited and prices are high, people feel rich and confident. They buy more because everything seems to be going up. When Mr. Market is depressed and prices are crashing, people feel terrified. They panic and sell everything at the worst possible time. Graham says the intelligent investor does the exact opposite. When Mr. Market shows up in a panic and offers you incredible bargains, that is when you buy. When Mr. Market shows up euphoric and offers you absurdly high prices, that is when you consider selling. And on all the other days when his prices are somewhere in the middle, you simply ignore him. Think about how different this is from what most people do. Most people check their portfolio 50 times a day. They obsess over every tiny price movement. They celebrate when their stocks go up 2% and they lose sleep when they drop 3%. They have essentially handed over their emotional well-being to Mr. Market. They have made him their master instead of their servant. Graham says Mr. Market should be your servant, never your master. His job is to offer you prices. Your job is to decide whether those prices make sense. If they do not, you do nothing. You wait. You let him come back tomorrow. This is such a simple idea, but it is incredibly hard to follow in practice. Because when everyone around you is panicking, every instinct in your body screams at you to sell. And when everyone is making money and celebrating, every instinct says to jump in before you miss out. Graham says those instincts will destroy you. The market does not reward the emotional, it rewards the patient, it rewards the rational. It rewards the person who can look at Mr. Market, smile, and say, "No thanks, I will wait for a better offer." Warren Buffett built his entire career on this one idea. He has said that Chapter 8 of The Intelligent Investor is the most important thing ever written about investing. Not one of the most important, the most important. Because once you truly understand that the market is there to serve you and not to guide you, everything changes. You stop reacting, you start thinking, and that is when real wealth begins. The investor and his advisors. Now, Graham dedicates an entire chapter to something most finance books completely ignore: the people around you who claim to help you with your money, your advisors. And Graham does not hold back here. He says the world is full of people who want to tell you what to do with your money. Stockbrokers, financial planners, newsletter writers, TV analysts, that one uncle at Thanksgiving who swears he knows which stock is about to explode. Everyone has an opinion, everyone has a tip, and Graham says the intelligent investor needs to be extremely careful about who they listen to. Here is the problem. Most financial advisors and stockbrokers do not make money when you make money. They make money when you trade. Every time you buy or sell, they earn a commission. So their incentive is to get you to do something, to move your money around, to react to every piece of news, to chase the next hot stock. Graham says that is a fundamental conflict of interest. The person advising you benefits from activity, but you, as an investor, benefit from inactivity. You benefit from buying great companies and doing absolutely nothing for years. That is the opposite of what makes your broker money. So what does Graham recommend? He says if you are going to use an advisor, choose one who charges a flat fee or a percentage of your total portfolio, not someone who earns commissions on trades. Because a fee-based advisor makes more money when your portfolio grows. That means their interests are aligned with yours. They want you to do well because that is how they get paid more. Graham also warns about financial media. The newspapers, the TV shows, the magazines with dramatic headlines about market crashes or the next big thing. He says these outlets are in the entertainment business, not the investing business. Their job is to grab your attention, not to make you rich. And the more dramatic and emotional the headline is, the worse the advice usually is. Think about it. When have you ever seen a headline that says markets are fine, do nothing, just be patient? Never. Because that does not get clicks. That does not sell magazines. Instead, you see market crash coming, protect yourself now, or this stock could 10x in 6 months. That is designed to make you emotional, and emotional investors lose money. Graham's advice is simple. Be very selective about who you let influence your financial decisions. The best advisor is one who tells you to be patient, stay disciplined, and do less. If your advisor is constantly calling you with new ideas and exciting opportunities, that is not advice. That is a sales pitch. And if you cannot find a good advisor, Graham says that is okay too. A defensive investor with a simple, diversified portfolio and the discipline to leave it alone will outperform most people who pay thousands of dollars for professional advice. Sometimes the best financial advice is to stop listening to financial advice. Security analysis for the lay investor. Now, when most people hear the words security analysis, their eyes glaze over. They think it is something only Wall Street professionals with fancy degrees and Bloomberg terminals can do. But Graham says that is nonsense. He believes any ordinary person with basic common sense can learn to analyze a company well enough to make smart investment decisions. And he breaks it down into simple pieces. Graham says when you are looking at any company, you really need to focus on 2 things: the company's past record and its future prospects. And here is the part most people get wrong. Graham says you should put far more weight on the past record than on future predictions. Why? Because the past is factual. It is real. It already happened. You can look at 10 years of earnings and see exactly how the company performed through good times and bad times. But the future is a guess. No matter how smart the analyst is, no matter how sophisticated the model, predicting the future is unreliable. Graham says Wall Street's biggest weakness is its obsession with future projections. Analysts spend all their time trying to predict what a company will earn next year or 5 years from now, and they present these predictions with incredible confidence. But the truth is, most of these predictions turn out to be wrong, sometimes wildly wrong. So what should you actually look at? First, earnings stability. Has the company made money consistently over the past 10 years? Graham does not want to see wild swings from massive profits one year to huge losses the next. He wants steady, reliable earnings. That tells you the business is solid and can survive different economic conditions. Second, earnings growth. Have the company's earnings been growing over time? Graham says you want to see at least a 1/3 increase in earnings per share over the last 10 years using 3-year averages. That means the company is not just surviving, but actually moving forward. Third, financial strength. Look at the balance sheet. How much debt does the company have compared to its assets? Graham says for industrial companies, the current assets should be at least twice the current liabilities. That means the company has a healthy cushion to handle short-term problems without going into crisis. Fourth, dividend record. As we talked about earlier, Graham loves dividends. A long history of paying dividends tells you the company generates real cash and shares it with its owners. It is the ultimate proof that the earnings are real and not just accounting tricks. Fifth, price-to-earnings ratio. This is simply the stock price divided by the company's earnings per share. Graham says you should avoid stocks where this ratio is too high. A high ratio means you are paying a premium price based on high expectations, and high expectations are dangerous because they leave no room for disappointment. Now, Graham is very honest about this. He says security analysis is not a perfect science. It will not help you predict the future with certainty, but it will help you avoid obvious traps. It will help you separate solid businesses from shaky ones, and it will give you the confidence to invest based on facts rather than feelings. And that is really all you need. You do not need to be a Wall Street genius. You just need to look at real numbers, ask simple questions, and avoid companies that cannot pass these basic tests. Graham says the goal of security analysis for the ordinary investor is not to be brilliant. It is to avoid being foolish. And avoiding foolishness is more profitable than most people realize. Stock selection for the defensive investor. Now, Graham does not just give you theory and leave you to figure it out on your own. He actually gives the defensive investor a specific checklist, a set of clear criteria that any stock must pass before you even consider buying it. And this checklist is one of the most practical things in the entire book. Let me walk you through it. Criterion 1. Adequate size. Graham says the defensive investor should only buy companies that are large enough to be considered significant in their industry. Why? Because large companies are more stable. They have more resources to survive tough times. They have been tested by the market and proven they can endure. Small companies might have exciting potential, but they also carry far more risk. Graham says leave those to the enterprising investors. Criterion 2. A sufficiently strong financial condition. Graham wants the company's current assets to be at least double its current liabilities. He also says long-term debt should not exceed working capital. In simple terms, the company should not be drowning in debt. It should have a strong, healthy balance sheet that can handle economic downturns without breaking. Criterion 3. Earnings stability. The company should have reported positive earnings in each of the past 10 years, not 7 out of 10, not 8 out of 10, all 10. Graham wants proof that this company makes money consistently, no matter what is happening in the economy. 1 or 2 losing years in a decade tells you the business might have structural weaknesses. Criterion 4. Dividend record. The company should have an uninterrupted history of paying cash dividends for at least the past 20 years. This is one of Graham's strictest rules, and for good reason. Dividends are proof that the company is not just earning money on paper, but actually generating enough cash to pay its shareholders. 20 years of dividends means the company survived multiple recessions and still kept paying. Criterion 5. Earnings growth. The company's earnings per share should have increased by at least 1/3 over the past 10 years, using 3-year averages at the beginning and end. This ensures the company is not just stable, but actually growing. A company that earns the same amount today as it did 10 years ago might be safe, but it is not moving forward. Criterion 6. Moderate price to earnings ratio. The current stock price should not be more than 15 times the average earnings of the past 3 years. This keeps you from overpaying for a stock just because it is popular or hyped up. Graham says paying too much for even the best company in the world is still a bad investment. Criterion 7. Moderate price to book ratio. The stock price should not be more than 1.5 times the company's book value. Book value is basically what the company would be worth if you sold all its assets and paid off all its debts. Graham does not want you paying 3 or 4 times what the company's assets are actually worth. That leaves too much room for disappointment. Now, here is the thing. Most stocks will not pass all 7 criteria, and that is exactly the point. Graham designed this checklist to be strict because his goal is to keep you out of trouble. He would rather you miss a good opportunity than get caught in a bad one. If you simply go through the market and only buy stocks that pass every single one of these 7 tests, you will end up with a portfolio of boring, stable, financially strong, reasonably priced companies. And Graham says that boring portfolio will beat the vast majority of investors over time. No excitement, no drama, no checking your phone every 5 minutes, just a quiet, disciplined portfolio doing its job while you live your life. That is the defensive investor's edge. Not brilliance, not speed, just standards that most people are not patient enough to follow. Stock selection for the enterprising investor. Now, if the defensive investor's strategy is about building a fortress, the enterprising investor's strategy is about going on a treasure hunt. You are actively searching for stocks the market has mispriced. Stocks that are worth significantly more than what they are currently selling for. But Graham is very clear. This is not about being reckless or taking wild bets. This is about finding bargains through superior analysis. You are not gambling. You are shopping for value, while everyone else is shopping for hype. So what does Graham tell the enterprising investor to look for? The first and most important category is what Graham calls bargain issues. These are stocks that are selling for significantly less than their intrinsic value, and Graham has a very specific way of identifying them. His favorite method is what he calls the net current asset value approach. Here is how it works. You take a company's total current assets, cash, receivables, inventory, then you subtract all of its liabilities, everything the company owes, not just current liabilities, but total liabilities. Whatever number is left is the net current asset value. Now, if the stock price is below that number, Graham says you have found a bargain. Think about what that means. You are buying the entire business for less than the value of just its liquid assets alone. You are essentially getting the company's buildings, equipment, brand, products, and future earnings for free. The market is pricing the business at less than its liquidation value. Graham says when you find stocks like this, you buy them. Not just one, you buy a basket of them. 10, 15, 20 of these bargain stocks, because individually some of them might fail. Some might be cheap for a legitimate reason. But as a group, the winners will far outweigh the losers. The second thing Graham tells the enterprising investor to look for is companies going through temporary trouble. Maybe the company missed earnings expectations for 1 quarter. Maybe there is a lawsuit that scared investors. Maybe the entire industry is out of favor right now. Whatever the reason, the stock has been beaten down. But here is the critical question. Is the problem temporary or permanent? If a company is losing money because consumer tastes have permanently shifted away from its products, that is not a bargain. That is a trap. But if a great company with a strong balance sheet is down 30 or 40% because of one bad quarter or a short-term industry slowdown, that could be an incredible opportunity. Graham says the enterprising investor must learn to tell the difference, and that takes work. You have to read the financial statements. You have to understand the business model. You have to think independently and ignore the noise. The third area Graham highlights is special situations. These are things like mergers, acquisitions, spin-offs, and restructurings. When companies go through these events, their stock prices often become temporarily dislocated. The market does not know how to value the new situation, and that confusion creates opportunities for the prepared investor. Now, here is Graham's honest warning. He says the enterprising approach sounds exciting, and it can be very rewarding. But it demands a level of discipline and intellectual honesty that most people simply do not have. You have to be willing to buy when everything feels terrible. You have to be willing to go against the crowd, and you have to be willing to sit on your hands when there are no real bargains available. If you cannot find genuine bargains, do nothing. Wait. The market always creates opportunities eventually, but only for those who are patient enough to wait for them. The enterprising investor does not find more opportunities than everyone else. They simply have the courage and preparation to act on the opportunities that everyone else is too scared to touch. Margin of safety. This is it. Chapter 20, the final chapter of The Intelligent Investor. And Graham himself says this is the single most important concept in the entire book. If you forget everything else and only remember one idea, this is the one, the margin of safety. So what is it? Let me explain it with a simple analogy. Imagine you are an engineer building a bridge. You calculate that the bridge needs to support 10,000 pounds of weight. Do you build it to hold exactly 10,000 pounds? Of course not. You build it to hold 15 or 20,000 pounds. That extra capacity is your margin of safety. It protects you in case your calculations were slightly off, in case the materials were not as strong as expected, or in case something happens that you did not predict. Graham says investing should work exactly the same way. When you buy a stock, you are making an estimate of what the company is worth. But no matter how careful your analysis is, it is still an estimate. You could be wrong. The economy could shift. The company could hit unexpected problems. Your assumptions about future earnings could be too optimistic. So Graham says never buy a stock at full price. Always demand a discount. Always leave a gap between what you think the company is worth and what you actually pay for it. That gap is your margin of safety. Let's say you analyze a company and determine it is worth $50 per share. Graham says do not buy it at 50. Do not buy it at 48. Wait until it is selling for $35 or even $30. That $15 to $20 gap is your cushion, your protection against being wrong. If your analysis was perfect and the company is truly worth 50, you got a bargain and you will make great returns. If your analysis was slightly off and the company is only worth 40, you still paid 30, so you are fine. And even if things go worse than expected and the company is only worth 35, you barely lose anything because you bought at 30. But what if you had paid $50? Then even a small error in your analysis could result in a significant loss. You left yourself no room for mistakes, no cushion, no safety net. Graham says this is the fundamental difference between intelligent investing and everything else. The intelligent investor always builds in a buffer, always assumes they could be wrong, always pays less than what something appears to be worth. Now here is the part that connects everything in the book together. The margin of safety is why Graham insists on buying stocks with low price-to-earnings ratios. It is why he wants strong balance sheets and long dividend records. It is why he talks about Mr. Market and waiting for panicked prices. Every single principle in this book ultimately serves one purpose: to make sure you buy with a margin of safety. Graham says when you buy with a large margin of safety, you do not need the future to be perfect. You do not need the economy to boom. You do not need the stock market to go up. You just need things to be okay. And most of the time, things turn out okay. But when you buy without a margin of safety, you need everything to go right. You need the company to hit every target. You need the economy to cooperate. You need investor sentiment to stay positive. And when has everything ever gone perfectly? That is why so many investors lose money, not because they pick bad companies, but because they pay too much for good companies. They leave themselves zero margin for error. Graham ends the chapter with a simple truth. The purpose of the margin of safety is to make accurate forecasting unnecessary. Read that again. You do not need to predict the future if you buy cheap enough. The discount itself protects you from whatever the future throws at you. That one sentence might be the most powerful idea in all of investing. You do not need to be smart enough to see the future. You just need to be disciplined enough to demand a bargain. And that is the margin of safety, the foundation of everything Benjamin Graham believed in, the concept that turned Warren Buffett into a billionaire, and the single most important lesson in this entire book. Closing. Key takeaways plus final CTA. So let's bring it all together. Let's recap the most important lessons from The Intelligent Investor by Benjamin Graham. Lesson 1. There is a difference between investing and speculating. Investing is based on thorough analysis, safety of your principal, and an adequate return. Everything else is speculation. Know which one you are doing at all times. Lesson 2. Inflation is the silent killer of wealth. Doing nothing with your money is not safe. It is slowly losing value every single day. You must invest, protect your purchasing power. Lesson 3. Know what type of investor you are. If you want simplicity and safety, be a defensive investor. If you are willing to put in the work, be an enterprising investor. There is no shame in either path, but be honest with yourself about which one you will actually follow. Lesson 4. Mr. Market is your servant, not your master. The market will offer you prices every single day. Some will be rational, some will be insane. Your job is to take advantage of the insane ones and ignore the rest. Never let the market's mood dictate your decisions. Lesson 5. Be careful who you listen to. Most financial advisors, media outlets, and so-called experts are not aligned with your interests. The best financial plan is often the simplest one that you actually stick to. Lesson 6. You do not need to be a genius to analyze stocks. Look at real numbers, earnings stability, financial strength, dividend history, and reasonable valuation. Avoid companies that cannot pass basic tests. Lesson 7. The margin of safety is everything. Never pay full price. Always demand a discount. Always leave room for being wrong. If you buy cheap enough, you do not need the future to be perfect. The bargain itself protects you. Benjamin Graham wrote this book in 1949. That is over 75 years ago, and yet every single lesson inside it is more relevant today than ever. In a world of trading apps, social media hype, meme stocks, and overnight millionaire stories, Graham's voice is the calm, rational, disciplined voice that cuts through all the noise. Warren Buffett did not become the greatest investor alive by being the smartest person in the room. He did it by reading this book at 19 years old and following its principles for the rest of his life. Discipline over intelligence, patience over excitement, safety over speculation. If you take even one lesson from this video and actually apply it to your financial life, you will already be ahead of most people. Now, if you enjoyed this summary, hit that subscribe button because we are breaking down the greatest finance books ever written on this channel. Every single week, a new book, a new set of lessons that can change your life. Hit the like button, drop a comment telling me which lesson from this book hit you the hardest, and share this video with someone who needs to hear it. And if you want to read The Intelligent Investor yourself, and I highly recommend that you do, the link is right in the description below. I will see you in the next one.